Knowing these business terminologies is crucial to securing a top job in consulting. Therefore, in this video, I'll be going through the 6 key terminologies, and for each, I'll explain what they are, how they're used, and worked examples. So we'll start with MICE. So MICE stands for Mutually Exclusive and Completely Exhaustive, and this is crucial to keep in mind when creating consulting frameworks. So let me just give you a quick recap into consulting frameworks. So frameworks are used in consulting when they want to break down a big problem, like how can this company increase their profits? That's quite a difficult problem to solve, so consultants break this big problem down into smaller problems which they can analyse individually to try and work out a solution to the big problem. And you may not realise it, but you use frameworks in your daily life. For example, let's say you were thinking of making a 3-course meal for someone, which is a very nice thing to do, but rather than thinking of everything you need to make in one go, you think, okay, what do I need to make for the starter? What do I need to make for the main and the dessert? You break the problem down into more digestible parts. So firstly, let's have a look at what mutually exclusive really means. So this means the parts of the segmentation or framework don't overlap, and this is used to really increase the efficiency of your work, because if they did overlap you would end up analysing the same thing twice. So is this good? No, they overlap and that decreases efficiency. So now let's get on to completely exhaustive. So this means the parts of the segmentation or framework don't miss anything, and this is crucial because if you missed the solution or the problem, then that wouldn't be very good. So take this square. Let's say everything inside this square forms everything you would need to think about when trying to answer some problem. So how can you segment this in a completely exhaustive way? Well, you can do something like this, because the 4 areas, the 4 sub-areas, form the total area of the square. When you're in your case interviews and you're creating frameworks, it's always good to keep the idea of being MICE in your head, but don't explicitly say to your interviewer, oh, I'm being MICE here. So let's get on to an example. Let's say a bread manufacturer has come to you because they want to increase the efficiency of their workflow, and they want you to pinpoint where they should focus their efforts to increase speed. So if you wanted to segment this problem in terms of the different stages of their workflow, you could think to yourself, well yeah, let's think about before the factory and after the factory. But is this MICE? Well no, because it's not completely exhaustive, because you've forgotten about the factory. Now is this a MICE structure? Well yes, we just said that it is completely exhaustive now that we've included the factory, but is it mutually exclusive? Well yes, because their entire workflow can be segmented into before the factory, and after the factory. And then to create a better framework from this, you would break down each of these different branches. So now, let's get on to market share. And this is all about quantifying how large a company or product is relative to a certain market. And this is normally done in one of 2 ways. Firstly, it could be done by revenue. And this is the company's revenue divided by the market revenue times by 100% to make it a percentage. But it could also be measured in terms of volume. So this is the company's volume divided by the market volume of sales times by 100%. Now you may think to yourself, these 2 are very similar and tell you the same things, but in actual fact they tell you 2 very different stories. Take Apple in the second quarter of 2019 and let's consider the global smartphone market. Now by revenue, Apple had a staggering 41% market share. But in terms of volume of sales, they only had a market share of 10.2%. Now, why is this? Now, it's simply because Apple's smartphones are more expensive relative to other smartphones out there. So that's why it's useful to know about both of these market shares. Now personally, with market share, I think the most important thing is to make sure everything is super clear. For example, when talking about Apple's market share, are you talking by revenue or by volume? And also, what market is this relative to? The general tech market or the smartphone market? And also, where are you talking about, in the US, in Europe, or globally? So just make sure everything is clear, and you can always clarify things with your interviewer. So when could you need this in a case interview? Well, take this example. Let's say Apple sold 7 million phones last year of a total phone market of 1 billion phones. So this means Apple would have a 0.7% market share by volume of sales. And the question is, how many more phone sales would Apple need to have sold to have reached 2%? So give this question a go. So in total, Apple would have need to have sold 2% times 1 billion to get at 20 million phones. But how many more phones is this? Well, it's quite simply 20 million minus 7 million, which equals 13 million. So the answer is 13 million. So thirdly, it's very useful to know some terminology to do with investments. And the two that we will look at are assets and return of investment, or ROI as it's otherwise known. So firstly, an asset is simply something the company owns. So take a bread manufacturer. They could have assets such as the machinery, the vehicles, or you could potentially think of their employees as assets. And some people say employees are the most important asset of a company. Now let's have a look at ROI. This is simply a measure of how good an investment was, but what is the equation? The equation is the net investment gain, so that is the money made from the investment minus the cost of investment, all divided by the cost of investment times by 100% to make it a percentage. And this essentially tells you how good an investment was relative to the cost of investment. So when would this be used in a case interview? So potentially in a market entry case study where a coffee shop wants to start selling cake and they want you to decide whether this is a good idea, but what is a good idea? So you need to ask them what constitutes success. Let's say they want a return of investment of 10% in the first month with an initial investment of $2,000. So the question is, how much revenue would they need to make for this to be viable? Well, firstly, let's calculate the net investment gain, which is simply the return of investment times by the initial investment, which will get you $200. But how much revenue would they need to make? Well, this is simply the $200 plus the $2,000 initial investment to get $2,200. So now let's get on to costs, and you probably know this already, but a cost is simply something the company spends money on, but categorizing the different types of costs can be really useful. So firstly, let's look at fixed costs. So these are expenses that don't vary depending on the volume of production, and you probably guessed it, but variable costs are expenses that do vary depending on the volume of production. So let's look at some examples. So again, let's take a bread manufacturer. What are some fixed costs? So this could be things like factory rent, wages, insurance, and some variable costs. This could include things like ingredients, fuel, and electricity. So let's get on to our third cost, and this is COGS, and this stands for cost of goods sold, and these are the direct costs involved when making a product. So let's think about a loaf of bread. What are the COGS involved with this? Well, it's the ingredients, the labour, and the energy that go into making this loaf of bread. But how are all these costs used in a case interview? Well, fixed and variable costs come in very handy when answering the question, why have our profits decreased? And with this question, it's always good to keep this framework in mind, which includes fixed and variable costs. With COGS, this comes in very handy when analysing a certain type of profit, which we'll come to later. So now let's talk about profit. Now profit is obviously fundamental to most businesses, so in turn is very important to consultants, and we'll be looking at three different types of profit. We'll be looking at net profit, profit margin, and gross profit, and these are all very important. So firstly, net profit is probably the profit you know most about, and it is simply your revenue minus your costs. Secondly, profit margin is your net profit divided by the revenue times by 100%. A higher profit margin is obviously just better, and you may have heard of pizza and pasta being very high profit margin foods, and this is because they cost very little to make but can be sold for a fairly high price point relative to the costs. So finally, gross profit is simply how much money you make directly from the product. So this is your revenue minus the COGS involved with making the product. So let's look at an example of how this could be used in a case interview. So let's say a company wants to achieve a profit margin of 10% and thinks they'll make about $1,000 of revenue. So the question is, what would their costs need to be for this to be viable? So firstly, let's calculate the net profit needed. So this will be 10% times by $1,000 to get $100 of needed net profit. But what would their costs need to be? So this would be 1,000 minus 100 to get 900. So their costs would need to be no bigger than $900. Now let's talk about the contribution equation, which is very good to keep in mind in any sort of case study. So the equation is profit equals price minus variable cost, and that is sometimes called the contribution margin, times by quantity minus your fixed costs. But how could this equation be used in a case interview? So let's look at an example. Let's say in your interview you've done some market analysis and you've worked out that this coffee shop will only feasibly be able to sell 500 cups of coffee a day. They've told you they need a daily profit of $1,000, their daily fixed costs are $200, and it costs 30 cents to make a coffee. And the question is, what price do they need to serve the coffee at for this to be feasible? Well, let's use the contribution equation to work this out. So this will be the $1,000 of daily profit plus the $200 of daily fixed costs divided by the quantity plus the 30 cents of how much it costs to make a coffee to get $2.70. Now if you don't understand this, just take a look at the contribution equation and try to work this out. And the question I want you guys to answer in the comments is, what assumption have I made here? So I hope this video helps. If you've got any questions, then let me know in the comments. But for now, I wish you all the very best of luck with your consulting applications.